Tesla is worth anywhere from $250 billion to $300 billion in the market these days. When company shares price move very high, some consider splitting the shares so that the lower prices will attract more investors. This can be a positive for stock performance over the long term. Tesla will split its stock 5-for-1 on August 31st. And Apple will complete a 4-for-1 split the same day. So why they're splitting their stocks? Hi there, welcome to Investors Game. Today, we're gonna talk about why Tesla and Apple are splitting their stocks. And give us a thumbs up, that helps us a lot, so let's get started. First, Apple, then Tesla. Almost a quarter of the US stock split their stocks in 1982. But this is very rare when companies decide to split their stock price. Companies such as Amazon and Google becoming increasingly casual about four-figure stock prices. A stock split is pure cosmetic affair. Apple, which last week traded around $560 per share, has announced a 4-for-1 stock split. Instead of having one share worth $460, a 4-for-1 split means shareholders will have 4 shares trading at $115. Nothing fundamental has changed. On the other hand, if one share of Tesla costs $1,650, after August 21st, its share will cost $330. Some analysts believe that the stock split itself is simply a cosmetic accounting thing that brings the stock prices down. But the reason that it's bullish is that it's a signal of something that is good news on the fundamental part. Now, how Tesla and Apple can affect the index price? Well, before we have mentioned that only 2 Standard & Poor's 500 companies split their price last year. But when stocks decide to split their stock price, indexes such as Dow Jones and Nasdaq, they might be affect their prices because Tesla won't cost $1,650 per share and Apple won't cost $460 as well. Now, you might be wondering, but why companies split their shares? Well, a stock split is usually done by a company that have seen their share price increase to levels that they are either too high or are beyond the price level of similar companies in their sector. The primary motive is to make shares seem more affordable to small investors even though the underlying value of the company has not changed. This has the practical effect of increasing liquidity in the stock. When a stock splits, it can also result in a share price increasing, following a decrease immediately after the split. Since many investors think the stock is now more affordable and they decide on buy the stock, they end up boosting demand and drive up prices. Another reason for the price increase is that the stock splits provides a signal to the market that company's share price has been increasing and people assume this growth will continue in the future. And again, lift demand and prices. In 2014, Apple split its share 7-for-1 to make it more accessible for a larger number of investors. Right before the split, each share opening price was approximately $650. After the split, the price per share at the market open was $92 per share, which is 650 divided 7. Existing shareholders were also given 6 additional shares for each share owned. So an investor who owned 1,000 shares of Apple will have 7,000 shares post-split. Apple shares increased from 861 billion to 6 billion shares. However, the market remained largely unchanged at $556 billion. The day after the stock split, the price had increased to a high of $95. Also, there is a reverse stock split. Another version of a stock split is a reverse split. This process is typically used by companies with low share prices that would like to increase their prices to either gain respectability in the market or to prevent the company from being delisted. Many stock exchanges will delist stocks if they fall below a certain price share. In May 2011, Citigroup reverse split its shares 1-for-10 in effort to reduce its share volatility and discourage speculator trading. The reverse split increased its share price from $4.52 to $45.12 post-split, and every 10 shares held by an investor were replaced with 1 share. while the split reduced the number of its shares outstanding from 29 billion to 2.9 billion shares. The market of the company staying the same at approximately 131 billions of dollars. How do stock splits affect short sellers? Stock splits do not affect short sellers in a material way. There are some changes that occur as a result of a split that affects the short position, but they don't affect the value of the short position. The biggest change that happens to the portfolio is the number of shares being shorted and the price per share. But here we have an interesting stock, Kodak. Kodak has received a loan from the government of $765 million. Its stock went up by 2,190% the next day. Within 2 days, the stock was trading at $60, with 284 billion shares changing hands. In the span of just 24 hours, more than 100,000 investors add the stock to their account on Robinhood. The stock was so volatile that the day after the announcement, at one point it was up more than 600%. But here we got the bad news. The momentum didn't last forever. The stock ended closing at $14.84 per stock last week. That's a 75% below its recent high. However, the current price is still more than 400% above, where the stock traded ahead of the loan announcement. So, because a company is going up crazy, that doesn't mean we should buy it. Companies are struggling due to the coronavirus. One perfect example is J.Crew, GMC, etc. Also, we have seen that Kodak has been doing not very well in the past, and they probably won't have more plans in the future to increase their stock value, so they might be reduce the number of shares to keep up their stock price. But this is something that not many investors like. Imagine that you got 5 shares from a such as company, and they decide to reduce the number of shares, so now the stock will cost more, let you more vulnerable to lose your money. But before we move on, let's recap what you learned in this chapter. First, Tesla will split in stocks 5-for-1 on August 31st, and Apple will complete a 4-for-1 split the same day. Second, why companies split their stock price? A stock price is usually done by companies that have seen their shares prices increase to levels that are either too high or beyond the price level of similar companies in their sector. Third, stock splits do not affect short sellers in a material way. There are some changes that occur as a result of a split that affects the short position. Also, a reverse stock split is used by a company with low share prices that would like to increase these prices to either gain more respectability in the market or to prevent the company from being delisted. If you like this video, don't forget to hit the like button. Let me know in the comment box, would you invest in Tesla or Apple right now, or would you wait for a better opportunity? Subscribe to my channel because every week I'm in YouTube with new content, and do not forget to activate the bell so you don't miss any of our videos. See you next time.